Hello guys. So in the last session, we have understood the basics of secondary adjustment. We found out what is the meaning of primary adjustment. So we found out what is the meaning of primary adjustment, and then we went on to understand the meaning of secondary adjustment, and we also understood what is called as excess money, which is nothing but arm's length price minus transaction price, and this excess money is also called as your primary adjustment. Now, on top of that, we also understood that there are two cases where secondary adjustment will not be applicable. Primary adjustment will always be applicable. Secondary adjustment will not be applicable only in two cases. One, where the primary adjustment itself amounts to less than rupees 1 crore, and two, where the primary adjustment corresponds to assessment year 16-17 and earlier. Okay, so this is the non-applicability clause of section 92 CE. Then we went on to understand 5 scenarios where secondary adjustment will be applicable, where it is suo motu primary adjustment considered by the assessee himself at the time of filing return of income. 2, where there is an assessment order or an appellate order passed adjudicating a primary adjustment and it has been accepted by the assessee, then it constitutes a secondary adjustment by default. Then, where there is a mutual agreement procedure or mutual arrangement procedure between the assessee and the department, and this department has gone ahead and passed a resolution for the same in agreement with the other country, then it also results in a primary adjustment. If it results in a primary adjustment, it will automatically constitute a secondary adjustment. Then the fourth point that we saw was with respect to advance pricing agreements. Fifth one was with respect to safe harbor rules. So if primary adjustment happens on account of these 5 reasons, then there will definitely be a secondary adjustment, provided the primary adjustment corresponds to assessment year 17-18 and afterwards, and the primary adjustment value is beyond rupees 1 crore. Fine. Now, what did we understand? Primary adjustment becomes secondary and it has to be repatriated within a specified time limit. So that brings us to the next question. What is the specified time limit? So what is the specified time limit? Now before that, let us have a acronym or a simple term which will help us remember these 5 scenarios. These 5 scenarios can be remembered as suo motu, assessment appeal, mutual agreement procedure, APA, and then safe harbor rules. So we can call it as SAMAS. So the first S stands for suo motu, the A stands for assessment order or appellate order, M stands for MAP, and then another A stands for APA, and then the final S stands for safe harbor rules. Fine. Now, what is the specified time limit? That cannot be a single time limit. Why? Because there are 5 different scenarios where there can be primary adjustments which will get transformed into secondary adjustment. So each of these 5 scenarios will require a specific time limit. Okay, but the number of days is given as a frozen number. Number of days is given as 90 days. So 90 days is the time limit you have to repatriate. But the next very important question is, from when is this 90 days to be computed? Okay, so what is the next question that we are trying to answer? For secondary adjustment, we have to repatriate the money from the associated enterprise. What is the time limit specified? 90 days. But from when? For answering this when, we will have to look at these 5 scenarios independently. Now, case number 1 from the SAMAS. The first one stands for what? Suo motu. Okay. Now, suo motu. When it comes to suo motu, what you have to understand is that I have made the adjustment, primary adjustment in the return of income. Fine. So, the time limit shall be 90 days from the due date of filing return of income under section 139(1). I myself have identified the primary adjustment, I have accepted the primary adjustment and gone ahead and filed the return of income. Now, when I file the return of income, it is automatic that the primary adjustment will be made, taxes will be paid. So, the due date for filing return of income is the trigger point for the purpose of determining the 90-day period. So, from the due date of return of income, for example, since this is a transfer pricing company, 30th November 2021. Forget the fact that there are extensions given. Let us take a regular case scenario and understand. 30/11/2021 is the due date for filing return of income under section 139(1). Now, 90 days is the time limit. So, what is the time limit? So, December will be 31 days and then January 31 days, February 28 days. Fine. Now, if I add these, it will be 90 days. So, if there is a suo motu adjustment made, AIPL makes a suo motu adjustment in the return of income for the primary adjustment, then the secondary adjustment, money should be repatriated. Money should be repatriated by 28th of February 2022. For the assessment year 22-23, they have to ensure that the money is getting repatriated. Sorry, for the assessment year 21-22, they have to ensure that the money is getting repatriated by 28th February 2022. Okay, so this 28th February 2022 indicates the last date on which you are accepted to repatriate the money without any treatment of loan, advance, etc. Now, suppose AIPL is not able to recover the money by 28th of April. 1st of March, this will be treated as an advance. Yes or no? No. No. That is where there is a difference in treatment. So, let us not jump into the advance, interest, etc. We'll put that on hold. For now, let us understand what is the time limit to repatriate. What is the time limit to repatriate? The time limit to repatriate is 90 days from the due date of filing return of income, where the primary adjustment is suo motu. So, return of income due date is 30th of November. I have gone ahead and filed the return on or before this particular due date. Then I should be able to repatriate this money by 28th February 2022. Is it clear? Yes? No. S is addressed. Next one. Assessment or appellate order. Now, as we discussed in the last session, there is a very important clause to this particular point. What is there? It should be accepted by the assessee. If it is to be accepted by the assessee, then there should be no appeal pending against the same. So, if that is the case, we will have to consider 90 days from the date of order accepted by the assessee. Now, let us take for example, for assessment year 1920, for assessment year 1920, 143.3 order, assessment order read with section 92CA is received on, let us take for example 31st October 2021. It is received on 31st October 2021. Now, up to what period of time, and let us assume that assessee has accepted this order. This is an order, assessment order. Assessee has accepted, yes sir, I fully agree with the adjustments made by you. I will pay the tax, and he has paid the taxes also. Now, what is the time limit available for receiving the money from the foreign associated enterprise? So, November 30 days, December 31 days, and then January 29 days. Yes? So 31 plus 29 will be 60 plus 30, 90. Therefore, 29th of Jan is the due date for the purpose of receiving the money from the foreign associated enterprise. Okay, in place of 143.3, suppose it is a CAT appeal order or an ITAT order, and against that order you have accepted and the primary adjustment is finalized, it becomes secondary adjustment. From the date of CAT appeal order or the date of ITAT order, you will have to consider 90 days and arrive at the date up to which you have to get the money repatriated from the foreign associated enterprise. Is it clear? Fine. So, suo motu, 90 days from the date of, due date of, very important, don't get carried away, due date of filing return of income. Fine. Now, with respect to the second case, assessment, it is 90 days from the date of appellate order or the date of assessment order accepted by the assessee. Now, the next case, what is the next case? MAP. So, date giving effect to the resolution passed from this 90 days. So, for example, between India and Singapore, suppose there is a resolution passed for MAP on 30th of November 2021. So, this is the date of resolution. So, India and Singapore have agreed on this date that this particular income shall be taxed in this country at this rate and only this method shall be used. So, if this kind of a resolution is entered into and if there is a primary adjustment arising on this regard, from 30th November plus 90 days on 28th of February, they should get the money repatriated from the Singapore entity. Is it clear? So, this is with respect to MAP. Fine. So, we have seen 3 out of the 5. Fourth one, APA. Now, please pay attention. APA, there are 2 subdivisions. What are the 2 subdivisions? Subdivision number 1. APA before due date under section 139. APA after due date under section 139. Let's take an example to first understand what we are trying to understand here. As we have discussed earlier, APA, for example, I want to take an APA from the assessment year 1920, 2021, 21-22, 22-23 and 23-24. So 5 years, 1, 2, 3, 4 and 5. And I go ahead and apply for APA. Okay, I apply for APA here and the APA is entered into on 30th of November 2021. I have applied somewhere here, but this is the date when the authorities have accepted. Which date? This 30th of November 2021 is the actual date on which APA is entered into. The authorities have agreed and we have finally entered into the APA. Now what has happened? For these 2 years, the due date of filing return of income, okay, let us not keep it as 30th of November, we will change it. We will call it 31st July 2020. This is the date on which APA is entered. Now, during this period, what has happened? For these 2 years, the due date of filing return of income has already been filed. It is lapsed. The due date of 139.1 has already lapsed for these 2 years, 1920, 2021. But for the remaining 3 years, the APA is entered before the due date under section 139.1. Is it correct? Because the date of APA is 31st July 2021. Now, for these 2 years, I would have filed the return of income without considering the APA. Therefore, the APA is entered with respect to these 2 years. After the due date of filing return of income. But for these 3 years before the due date of filing return of income. Now, how do I make the secondary adjustment? Now, what has happened? Because of APA, there is a primary adjustment here and there is a primary adjustment here. This is for what? For the year 21-22, there is a primary adjustment. As of today, 31st of July, I know that for the year 21-22, there is a primary adjustment. Okay, then what will happen? I will have to take 90 days from the date of filing return of income. Please be very careful. The term used is date of filing return of income under section 139(1). So it is the date of filing return of income from which you will be considering 90 days for repatriation. For repatriation, where you have entered into APA and there is a primary adjustment arising on account of APA, return of income is not filed yet, not yet filed, then you have a time limit of 90 days from the date of filing return of income. It is not due date. It is not due date. Suppose I file the return of income on 20th November. I will have to take 90 days from here. I will have to take 90 days from here. So please be very careful. The terminology used is 90 days from the date of filing return of income for under section 139(1), which will be considered as the time limit for the purpose of repatriation. This is where the APA is entered into before filing return of income. Suppose APA is filed after the return of income. APA is filed after the return of income. What will happen in this case? 90 days from the end of the month in which APA is entered. So, luckily for us, this illustration says the APA is entered on 31st of July, which also happens to be the end of the month. So, which means what? August will have 31 days, September will have 30 days, October will have 29 days. So, 29th of October, you must make sure that secondary adjustment is recovered for these two assessment years. Why? Because for these two assessment years, what happened? APA has been entered after the due date. Please don't get confused with these numbers here. APA is entered after the due date for which assessment year? 1920, 2021. Because you have already filed the return of income for those two assessment years. APA is entered after the return of income. You go file the modified return and then you find out that there is a primary adjustment. This primary adjustment becomes a secondary adjustment by virtue of 92 CE. You have to get it repatriated within 90 days. What is the time limit? From the end of the month in which you have entered into the APA. Suppose in this example, APA is entered into on 10th July. Suppose it is entered into on 10th July 2021, still the due date remains to be the same because end of the month is 31st July. 90 days from the end of 31st July, which is going to be 29th of October. Even if you enter it on 2nd of July, even if the APA date is on 2nd of July, the repatriation time limit remains to be 29th of October. Fine. So point number 4, very important. Please remember there are two subdivisions where the APA is entered into before the due date of filing the return. APA is entered into after the due date of filing the return. Where the APA is entered into before the due date of filing the return, 90 days from the date on which the return of income is filed. 90 days from the date on which return of income is filed. Now after the due date of filing return of income, 90 days from the end of the month in which your particular APA has been entered into. Okay, this is for the purpose of repatriation. And when it comes to safe harbor rules, it is exactly like suo motu. Safe harbor rules is again like suo motu because at the time of filing return itself, you would have already complied with safe harbor rules. Primary adjustment would have arisen at that point of time itself. Therefore, 90 days from the date of due date of filing return of income, 90 days from the due date of filing return of income, you will have to recover the primary adjustment. Okay, so let's quickly recapitulate what we have seen so far. You must see this lecture one more time so that you get the grip of whatever discussion we are making right now. Okay, so point number one, in case of suo motu, time limit available is 90 days from the due date of filing return of income. Case number two, assessment, 90 days from the date of assessment order or appellate order accepted by the assessee. Now, point number three, MAP, 90 days from the date of resolution passed accepting the mutual agreement procedure between the two countries. Then, fourth point, with respect to APA, if it is filed, APA is primary adjustment is on account of APA, and if such adjustment is for assessment year where return of income is not yet filed before the due date, then what will we do? We will take 90 days from the date of filing return of income as the date for recovery. Where the APA is entered into after the due date of filing return of income, it should be 90 days from the end of the month in which APA has been entered into. In case of safe harbor rules, it is just like suo motu, it is 90 days from the due date of filing return of income. Now, what have we seen? We found out what is the meaning of primary adjustment. We found out what is the meaning of secondary adjustment. Then we found out when secondary adjustment is not applicable, and then we understood when secondary adjustment will arise, and then what is the time limit for the purpose of recovery of the money called as secondary adjustment. Now comes the next part. What is the next part? If this secondary adjustment is not repatriated within 90 days, what happens? So, consequence of non-repatriation. What will we do? Treated as loan given and interest income on loan shall be offered to tax. Now, there are three things which we should understand from this. When there is a secondary adjustment, there is a time limit to get the money refunded back from the associated enterprise, which is what we just saw right now, 90 days for those 5 cases. If we don't get it refunded back within those 90 days, what is the consequence? This secondary adjustment will be treated as a loan given by the Indian entity to the foreign entity, and they will accrue an interest on this loan, and they will keep taxing this interest till the date you get the money from your foreign entity. Suppose Singapore entity has not refunded the money for 31st March 2022. You will charge interest. 31st March 2023 they have not refunded. Still you will charge interest for 1 full year. 31st March 2042 they have not refunded. Even that year you will charge interest. So now this is the headache of this provision, and this also infuses the responsibility on the Indian entity to collect money from the foreign associated enterprise. Okay, now this leads us to 2 questions. What is the period of interest? What is the rate of interest? Okay, so let us address one at a time. Period of interest. Now, we should also understand one more thing. Period of interest will apply only when there is a loan. When will loan happen? Those 5 cases. If you don't repatriate within those 5 time limits, you will result in creating a loan, and then you will have to charge an interest. Correct? So, let us address each scenario separately so that we will get a good understanding. First one, suo motu. So, what is suo motu? What is our understanding on suo motu? At the time of filing return of income, I find out what is the primary adjustment, I make the primary adjustment, I pay taxes, file return of income. And then I classify that as secondary adjustment, and 90 days from the due date of filing return of income, I am supposed to recover that amount. I am supposed to recover that amount from my associated enterprise. If I fail to recover the amount, from which period will I compute interest? Interest shall be due date of filing ROI under section 139(1) till year end or date of repatriation as the case may be. Whichever is earlier can also be used as the case may be. Now, what is the meaning of this? Let us take our example. AIPL filed its return of income disclosing primary adjustment of 10 crores on 30th of November 2021. By 28th of February, which is the 90 days time limit, they should have recovered this 10 crores from AJC. They have not recovered this 10 crores. So what happens? From 30th of November, that is from 1st of December, from the 1st of December, interest will be computed, not from 1st of March. No. If you fail to collect within 90 days, bang on from the due date of filing return of income, interest will be computed. Assume that they have not at all collected the money up to 31st of March 2022. What will be the period of interest? 1st December 2021 till 31st March 2022. This is how you have to understand it. Is it clear? So in case of suo motu, time limit to collect is 90 days from the due date of filing return of income. If you are unable to collect it within those 90 days, from the day succeeding the due date of return of income till the year end or till the date of repatriation, you will have to consider interest. Suppose they repatriate on 15th of March, you will have to consider interest till 15th of March. Suppose they repatriate it on, let us say 10th of March. Up to 10th of March, you will consider interest income. Suppose they repatriate it on 10th of February, no interest. Suppose they repatriate it on 30th of March, till 30th of March, interest. Suppose they don't repatriate it at all till 31st of March 2022, interest has to be computed. Is it clear? And this has to be, as the case may be, whichever is earlier, because suppose they repay it on 1st of April or 1st of May, you cannot compute till 1st of May. You will have to stop it with 31st of March only. You cannot go beyond the financial year, beyond the previous year. Now, this is for the first point, which is suo motu. Now, second case, assessment or appellate order. So, we will always go based on the Samas approach. Okay, so assessment or appellate order, what was the time limit that was given to us? 90 days from the date of assessment order or appellate order accepted by the assessee. Suppose they are unable to recover the amount from this 90-day period, they are unable to recover the amount from this 90 days period, date of order till year end or date of repatriation, whichever is earlier. So this is how we will tackle this particular point. So what will we do? We will take the date of order and then we will also take what is called as the due date for repatriation. If the due date for repatriation they are unable to recover the money, then they will have to start the interest computation from the date of order till 31st of March or the date of payment, whichever is earlier. Fine. So this is how you will have to understand the second aspect of assessment. Third is MAP. Now, what is MAP? There has to be a resolution which has to be passed on by the assessing officer, and the moment the motion for this, the moment the resolution is passed for MAP, 90 days from the date on which the resolution is passed has to be considered. If the 90-day period is lapsed and you are unable to recover the amount from the date of resolution of MAP, so date of resolution of MAP till year end or date of repatriation, whichever is earlier. Fine. Now, this is with respect to MAP. Now, with respect to safe harbor rules, just like the time limit, it is exactly same with respect to suo motu. Even the interest computation for safe harbor rules point, it starts from the due date of filing return of income. Fine. Now, let us jump on to the next one, which is APA. Again, APA is broken into two, which will be before due date of filing return of income and after due date of filing return of income. Now, for before due date of filing return of income, what was the time limit? 90 days from the date of filing return of income. 90 days from the date of filing return of income. But for the purpose of interest, very important, it shall be from due date of ROI under section 139. So, suppose you file the return of income on 20th of November. Okay, you file the return of income on 20th of November. Then probably it will not be 28th of February for the purpose of recollection of the money. So what will happen in that case? You will have to consider it as probably 19th of February as the due date for the recovery of money. But for interest computation, you will not take 20th November. You will take only 30th of November from the due date. This is where the provision slightly deviates. Okay. So for APA, which is filed before, APA entered into before the filing of return of income, the due date for repatriation starts from the date of filing of return of income, whereas the date for the purpose of commencement of interest is from the due date of return of income. Okay, so from the due date of ROI under section 139(1) till year end or repatriation, whichever is earlier. Okay, so this is for before cases. After cases, what was the time limit given? 90 days from the end of the month in which the APA was entered into. Suppose you are unable to collect within the 90 days from the end of the date in which APA was entered into, what will happen? You will have to consider from the end of the month APA was entered. So from the end of the month, for example, 10th July is the date of APA being entered into. So from 1st of August, you will have to consider the interest. You will have to consider the interest from 1st of August. Okay. So even the due date will be starting from 1st of August. Computation for repatriation will start from 1st of August. But when it comes to interest computation also, it will start at the same 1st of August in case you don't repatriate it within the 90 days from the end of the month in which APA was being entered into. Is this clear? So this is with respect to the 5 points for the time limit for period of interest. So let us quickly revise the time limit and the period of interest. What is time limit? Now what we will do is we will discuss it side by side so that we have a better understanding. Where the case of suo motu and safe harbor rules come up. Suo motu and safe harbor rules come up. What is the time limit? 90 days from the due date of filing return of income is the time limit for repatriation of money. Now, if repatriation in case 1 and case 5 is not done within this particular time limit, what will happen? From the due date of filing return of income till the year end or till the date of repatriation, whichever is earlier, you will have to compute interest. Now, case number 2. So case 1 and case 5 we have discussed. Case number 2. From the date of assessment order or appellate authority order, 90 days time is given for the purpose of repatriation. Suppose the repatriation does not happen within 90 days, what will we do? We will have to consider interest from the date of order till the year end or till the date on which the repatriation is completed, whichever is earlier. Then case number 3, which is on account of MAP. The resolution date, whatever date has been considered, from that resolution date 90 days is given for the purpose of repatriation. If repatriation is not completed within this 90-day period, from the date of resolution till the date of recovery or till the year end, you will have to compute interest. Now, last case, which is going to be on account of APA. If the APA is entered into before the due date of filing return of income, the time limit is 90 days from the date of filing return of income, not due date, date of filing return of income. And you will have to start computing interest in case you are unable to recollect the money within this period of 90 days from the due date of filing return of income. APA before alone, please read very carefully. And then when it comes to the second case, that is APA has been entered into after the due date of filing return of income, then 90 days from the end of the month in which APA has been entered into, and if you are unable to collect the money from the associated enterprise within this 90-day period, from the end of the month in which APA has been entered into till the year end or till the date of repatriation, whichever is earlier, you will have to compute interest. Is this clear? So we have understood what is secondary adjustment, when it does not arise, when it arises, what is the time limit, and then what is the time limit for repatriation, and then what is the period to be considered for interest computation. Now, next important question to be answered is, what is the rate of interest? Now, when it comes to rate of interest, we'll also have to understand that these are international transactions. Not always transactions will be denominated in INR. Though for our academic purpose, we keep denominating things in Indian rupee. Generally, it will also be in Indian rupee, or it can also be in foreign currency. So, the transaction, whatever transaction we are referring to, it could be denominated in INR, or it can be denominated in foreign currency, dollar, euro, whatever be. Now, the interest rate is going to vary depending upon the type of transaction. Okay, so case 1, where the transaction is denominated in INR, what is the interest rate? The interest rate as given in a specific rule. What rule is that? It is rule 10CB. It is rule 10CB, where they are specifying what is going to be the interest rate that we need to consider. So the interest rate is going to be SBI 1 year marginal cost of fund lending rate as on 1/4 of the previous year. So at the beginning of the previous year, whatever is the 1 year marginal cost of fund lending rate of SBI, that will be considered along with 325 basis points, or those who have already done a good amount of SFM will understand that this is also known as 3.25%. So, what is the meaning of this? Suppose 1 year marginal cost of lending rate will be given in the question and examination, don't be worried, is 9%. You will have to add 3.25 to this 9%, and 12.25% will be the interest rate which you have to apply on the money that is not repatriated within 90 days. Is it clear? So transaction should be denominated in INR, and if it is denominated in INR, you will have to consider the SBI 1 year marginal cost of lending rate, okay, plus 325 basis points or 3.25%, which will be what is called as the interest rate that you have to apply. Now, this is when the transaction is denominated in INR. Now, what happens if the transaction is denominated in foreign currency? If the transaction is denominated in foreign currency, what is the rate that I have to consider? I'll have to consider 6 months LIBOR as on 30th September. Okay, plus 300 basis points or 3%. Suppose it is 10%, LIBOR is 7. Okay, and then you will have to add 3%, and 10% will be the rate of interest that you will have to add. But sir, when it comes to tax computation, shouldn't it be in INR? What is the purpose of this foreign currency? Very good point. If that is the case, yes, the law provides for that issue as well, and it dictates how this is to be converted. So conversion of this particular denomination in foreign currency shall be TT buying rate. TT buying rate as on 31st March. So the last date of the previous year, on the last date of previous year, whatever is the TT buying rate, that rate has to be considered for the purpose of conversion of transaction denominated in foreign currency and the interest thereon. Okay, so now let's quickly revise the interest portion. Where the transaction is denominated in INR, then we'll have to take the SBI 1 year marginal cost of lending rate as on 1/4/2021 or as on 1st April of the beginning of the or as on the first or as the beginning of the previous year, you should take the marginal 1-year cost of lending rate and apply 3.25% in addition to that rate to arrive at the interest rate. So 1-year marginal cost of fund lending rate plus 3.25% shall be the interest rate, where it is going to be on account of foreign currency denominated transaction. For example, the primary adjustment is $1 million, that is transaction denominated in foreign currency. Then if it is going to be 10 crore rupees, transaction denominated in Indian currency. Okay, so if it is denominated in foreign currency, the rate of interest should be applied as 6 months LIBOR. That as on 30th of September. The dates are very important. Questions might test you on that. They might confuse you, so don't get confused. If it is INR, beginning of the year. If it is foreign currency, 30th of September. Plus 3%. 3.25 is for INR. 3% is for foreign currency. How do we convert the foreign currency balance? You will have to consider TT buying rate on the last day of the previous year, which is 31st of March 2022. Okay, for the current previous year. So with this we conclude on the interest portion. Now, there was a problem. What problem? Most of the MNCs, multinational companies, were not able to repatriate this money. Why? Because most of the MNCs had parents abroad, parent companies abroad. Those parent companies told, boss, nothing doing. We have paid anything and everything that has been agreed as per the contract. I will not pay a single penny to you. Go and dash. I will not be bothered. Okay, this dash means go and hit yourself. Please do not think that I am censoring anything here. So it means that they are not bothered about what happens. Now, all the MNCs in India took a huge hit because of this, because they had to keep on paying interest year on year, and this interest was subject to tax. Okay, they did not actually have to pay interest, but they had to keep paying tax on this interest. They somehow wanted to get out of this issue. They went and told, at least give us some exit option. Please give us some way to get us out of this problem. Don't keep us locked till eternity, because even till the Indian Indian counterpart of the MNC is shut down, we will never be able to repatriate. So please don't do this. We don't want to unnecessarily keep paying tax on interest on year on a fictitious amount. Then in the year 2019, Nirmala Sitharaman, our finance minister, came out with an exit option. She told, fine, we somehow agree with you for a fact that you might not be able to recollect this money from your foreign counterparts, but there is a loss of forex for the country as well. So to that extent, I want you guys to have a one-time payout, one-time tax payout. So what is it? One-time tax payout. One-time tax payout. One-time tax payout option. So what will you do? This one-time tax payout option is, you will have to make a tax payment on the secondary adjustment, and then the entire loan interest obligation will be offset. Entire loan interest obligation will be offset. So what did she tell? You make payment of 18% tax plus 12% surcharge plus 4% cess. So it will be 18% plus 12% of 18% plus 4% of tax plus surcharge, which will be 20.9664%. So whatever is the secondary adjustment, on that you simply pay out 20.9664%, and then no more interest will be added. No more interest will be added, and the secondary adjustment obligation will be offset. So what will happen if you do this? No more interest, and then no more secondary adjustment. Now you might ask me, sir, suppose 90 days, that period which we have seen so far now, that 90 days, suppose it ends on 28th of February. Suppose I have taken this exit option only on 30th of March. Will I have to take interest or not? you have to take interest. You have to offer interest up to 30th of March, because if you take this exit option within this 90 days, no problem. But if this exit option is taken beyond 90-day period, you must consider interest income up to the date of exit option. From the date of exit option, no more interest. Sir, if you do a problem, don't worry. We are going to do two different problems which will have a detailed understanding into each of the concept that we have seen so far. Okay, so with this, we have completed upon secondary adjustment. And small points that I want you to know is that, sir, we have paid tax on this secondary adjustment, sir. Can we take it as credit like advance tax, self-assessment tax? No. You cannot take any credit for that. Sir, the secondary adjustment, can I take as a deduction in PGBP? No. This is a one-time exit option. No more secondary adjustment going forward. No tax credit. No deduction also is available. Is this clear? So this is the entirety of this topic called as secondary adjustment. Quickly take the PDF that has been shared. Take the PDF that has been shared. Okay, so situations which result in secondary adjustment. Now what are they? Suo motu is one of the case. Assessment order, appellate order accepted by the assessee is one of the case. And then resolution of an assessment by way of MAP under an agreement entered into under section 1990. This is for MAP. Then primary adjustment is on account of APA, and then primary adjustment is on account of safe harbor rules. So these are the 5 scenarios where secondary adjustment will be applicable. Now, what is this? Excess money. This is a very important terminology. It is nothing but arm's length price minus transaction price. What we call as primary adjustment is also the excess money that we see here. Now, what can be the consequences of not repatriation? Whatever is the excess money will be treated as an advance. Whatever the excess money will be treated as an advance. This is given as an example. So A Limited has sold goods to B Corp, a Japanese subsidiary, at 10 crores. Based on application of 92C with 10C, 92C section and 10C rule, the arm's length price was determined as 2.5. So this 2.5 crores is the excess money. 2.5 crores is the excess money. So one more example is given just for you to understand. Now, time limit for repatriation on a suo motu basis. Time limit is within the time limit within which the repatriation shall be made shall be 90 days from the due date of filing return of income under section 139(1). Where it is on account of assessment or appellate order, 90 days from the date of the assessing order of the assessing officer or the appellate authority accepted by the assessee. Please remember, accepted by the assessee is very important. Now, primary adjustment is on account of MAP, 90 days from the date of giving effect by the AO resolution arrived at MAP, and the primary adjustment has been made on account of application of MAP. Okay. Now, with respect to APA, 90 days, there are two different scenarios. Before the due date of filing return of income, after the due date of filing return of income. If it is before due date of filing return of income, 90 days from the date of filing return of income. If it is after that, 90 days from the end of the month in which APA has been entered into. Then finally, safe harbor rules will follow the same rule of suo motu. Now, period for which interest is to be computed, that again we discussed, will be the due dates of return of filing return of income for suo motu and safe harbor rules. And then in case of assessment order or appellate order, it shall be the date of order. For MAP, it shall be the date of giving effect of the resolution. And then for the purpose of APA, where it is before filing due date of return of income, APA being entered into, the interest shall be computed from the due date. And if it is after, it shall be from the end of the month in which APA has been entered into. Now, rate of interest to be considered, if the transaction is international transaction is denominated in rupees, rate of interest shall be 1 year marginal cost of fund lending rate of SBI as on 1st April of the relevant previous year plus 3.25% or 325 basis points. And if it is foreign currency denominated transactions, 6 months LIBOR plus 30th September plus 300 basis points or 3%. Okay. Exchange rate shall be the rate, TT buying rate as on the last day of the previous year. Now, the exit option that was given was 18% tax plus 12% surcharge plus 4%, effectively 20.966%. The additional tax as detailed above has been remitted. no interest shall be computed from the date of remittance till the year end. From the date of remittance till the year end. Before the date of remittance, interest will be computed. Okay, the additional income tax shall be considered as final tax payment with respect to the excess money. So, whatever is the excess money, whatever tax you have paid, that is the final tax. No more interest, nothing. It is closed. And then no credit shall be allowed for tax paid. Okay, so now let us take up problem number 1. I will be solving the problem for you. I will be solving problem number 1 and problem number 2. What I want you to do is, problem number 3 is a homework problem. So I want you guys to make an attempt. I want you guys to make an attempt and revert to me on the Telegram channel as to what needs to be done as the answer. Okay, third problem is on APA. First problem is on first problem is on regular suo motu basis, and second problem is going to be second problem is on assessment cases. Fine. So now let us take problem number 1. First, let's read the problem and then let's resort to solving it. Now, A Limited has sold goods to B Inc. of USA, its AE, at 50 crores. And one more thing, guys, wherever whichever question is silent about whether they are AE or not, please understand it as AE, because you'll read the other parts of the question which gives you a hint that they are AE. For example, question is silent as to whether they are AE or not, but the question tells that the arm's length price determined was so and so, which means what? Obviously they are AE. That's why arm's length price determination itself is getting triggered. Okay, so that is how you have to understand. Sometimes the question might test you for certain other aspects. Don't try to be over smart and tell that since the question is silent about AE, it is deemed that they are not AE, therefore this does not arise. You will lose the entire marks. Okay, fine. Sold goods B Link at 50 crores. A Limited, however, ascertained the arm's length price as per 92C read with Rule 10C as 60 crores. The primary adjustment of 10 crores was incorporated by A Limited in the return of income which was filed on 20th of November 2021. The excess money, remember excess money, what is that? Arm's length price minus transaction price of 10 crores was not repatriated by B Inc. by 31st of March 2022. The SBI 1-year marginal fund lending rate was 9.75% on 1st April 2021. The SBI marginal lending rate on 1st April 2022 was 10%. With respect to the above facts, answer the following. Amount of excess money to be repatriated. So let me start here. I will also tell you how to present the answer for this type of problems. Okay, problem 1. Excess money. Excess money is equal to, this is how you have to write, arm's length price minus transaction price. You have to write this. You cannot directly write it as 10 crores. For that, they are not giving you marks here. So, which is how much? 60 crores minus 50 crores, which is equal to 10 crores. Okay, so this is the first question that is answered. Time limit for repatriation of excess money. Time limit. Time limit for repatriation. Now, so what case is this? If you look into the question, it says that the primary adjustment of 10 crores was incorporated by A Limited. So they themselves have found out what is the primary adjustment and they have incorporated it in the return of income. So it is a suo motu case. So suo motu primary adjustment case. Therefore, time limit for repatriation is equal to 90 days from the due date of filing return of income under section 139(1). The solution for this will not be available, so please see, write, so that you will understand what needs to be done. Please guys understand something which is very important. Unless you get into the habit of writing, you will not be able to complete tax paper. Okay, tax, income tax or direct tax as you know it is one of the most voluminous topic. The more you write, the better you get at elaborating the answer in the most perfect form. Giving detailed answers are important, but writing unwanted answers are not at all required, and they will take away your time. You may feel that the paper is easy, but still you may not get an exemption. This happens solely because you don't know what to write. You know the answer, but you write way too much or you write way too little. That is why writing is very important. The more you write, better clarity you get. Okay, now 90 days from the due date of filing, return of income under section 139(1). So what is the due date of filing? Due date of return of income under section 139(1). So what is the due date of filing return of income under section 139(1)? 30th November 2021. So 90 days. What is the 90 days time period? So December will be 31 days. Then January will be 31 days. And then February will be 28 days. So this is the 90 days. So excess money, you have to write like this, excess, not, you have to write it as EXCESS is to be repatriated by 28th of February 2022. Fine. So this is how we approach the solution. So that answers the second question. Rate of interest to be considered. Now this question is playing around with us. It has given us 9.75% as on 1st of April 2021. And April 2022 rate is given. April 2022 rate will not be applicable. Please understand. First day of the previous year is the date on which you will have to consider the interest. What date? First day of the previous year is the day on which you will have to consider the interest. Okay. So next one. Rate of interest. Transaction is denominated in which currency? In INR. You can call it Indian currency. I'm just writing it as INR, or you can do it like the rupee symbol in rupees. Okay. Now, therefore, 1 year SBI marginal cost of fund lending rate plus 3.25%, which is equal to 9.75% plus 3.25%. So how much is that? 9.75% plus 3.25%. Right? That will be, let me also simultaneously work it out. 9.75 plus 3.5, 13%. Correct? So 13% is the rate of interest. Fine, 13% is the rate of interest. Now, what else have they asked us to find out? Interest income to be considered if repatriation was not made on 31st of March 2022. Okay, now interest income is equal to excess money into rate of interest into period of interest. Now, what is the excess money? Excess money is equal to 10 crores. Rate of interest is equal to 13%, and then period of interest up to 28th of February, because 30th of November is the due date of filing return of income. Up to 28th of February is 90 days, 31 days in March, therefore it will be 121 days. How did I arrive at this? 31 December plus 31 Jan plus 28 February and 31 March. So that will be 121 days. Therefore 10 crores into 13% into 121 divided by 365. So how much is that? $43 lakhs. So 43 lakhs 9,589.04. Let's just cross check. So 10 into 13% into 21 divided by 365. Yeah, so 4309,589. So this will be the interest income in case they have not repatriated at all. They have not repatriated at all up to 31st of March 2022. So we have addressed this question also. Last question, tax payable and interest income, if any, if the exit option was exercised on 15th of March 2022. So first thing, let us find out what is the tax payable. Tax payable is equal to excess money into 20.9664%. So what is the excess money? 10 crores into 20.9664%, which will be how much? 2 crores 9 lakhs 66,000 and then 66,400, right? 2 crores 9 lakhs 66,400. Okay, so this is the tax payable. This is the exit option tax payable. Fine. Now next thing, when have they exercised this option? On 15th of March. When they should have exercised it, if they don't want to pay any interest, they should have exercised it before 28th of February, because 90 days ends on 28th of February. Fine. So now, how many days should we consider? We'll have to consider 104 days. How? 90 days after 28th of February and 14 days, not 15. On 15th, they have exercised the option. See, 31 days in December, 31 days in Jan, and then February it is 28 days. March it is 14 days. 15th day they have opted for the exit. So no interest on that day. Okay. So in total you have 104 days. You have 104 days. So let us compute the interest. Okay. So it works out to 10 crores into 13% into 104 by 365. How much is that? 37 lakhs 04,110. I am rounding it off. It is 109.59. I am rounding it off to 110 rupees. So 37 lakhs is the interest that they have to bear. Okay. So this concludes the first question. We have answered every aspect. What is the excess money? What is the time limit? What is the interest? What is the exit option available? And then we have also addressed what will be the interest till the date of exit option. Is it clear? Is this problem giving some insight into the concept that we have discussed so far? Fine. What we will do is, we will do one more problem, and in this problem, in the second problem, this portion I want you to take it up as a homework. This portion I want you to take it up as a homework. Interested students can reach out to me for the final answer. And problem number 3 is homework. You will have to do it on your own self and come back to me if you are interested. So problem number 2, let me take you through the first 1, 2, 3, 4, 5 subdivisions. Okay. Now, let us read the second problem. A Limited had its assessment completed for AY 1819, AY 1920. The assessing officer in the course of assessment had made reference to transfer pricing officer. The transfer pricing officer had suggested a primary adjustment of 10 crores for assessment year 1819 account of sale made to AE and 12.5 crores for AY19 on account of sale made. It is 2, not from. This one should be 2. Just change it. So it should be 2, another AE. The order under section 143.3 read with section 92 CA for 1819 dated 21st September 2021 was passed incorporating the adjustments suggested by TPO and was accepted by A Limited. So assessee has accepted the assessment order. Whether primary adjustment becomes secondary adjustment? Yes. No. And demand was paid in full. Okay, this is just supplementary information which doesn't serve the purpose of this question. Now, order under section 143.3 read with section 92CA for AY 1920 was also passed on the same date. So, can it happen like this? Yes, definitely it can still happen. However, for AY 1920, A Limited filed an appeal with CITA. Has he accepted the assessment order? No, he has not accepted the assessment order because he's filed an appeal. Now, CITA and the CITA passed an order upholding the addition made by AO. What has CITA told? CITA, Commissioner of Income Tax Appeals, has accepted the addition made by the assessing officer. And this order was received on 15th of November. An appeal was made by A Limited with ITAT and it is pending in this regard. So, as of now, what is the status? It is pending with ITAT and the assessee has not accepted up to CIT appeals level. Okay, now what else is the question telling? SBA 1 year lending rate on 421 is 9.75%. Ascertain the following: amount of excess money, time limit for repatriation, rate of interest, interest income, tax payable where the exit option is being exercised. Fine. Now, let us start. Excess money. Excess money is equal to arm's length price minus transaction price. What is the arm's length price? The arm's length price is, we don't know because they have directly told us what is going to be the adjustment. They have directly told us 10 crores is the adjustment. So this is the adjustment. 10 crores is the adjustment. Directly they have given us excess money. So nothing that we need to find out here. What is the second one? Time limit for repatriation. Time limit for repatriation. This is for AY 1819 and nil for AY 1920 because the excess money concept itself will be applicable for secondary adjustment purposes only where the order of the appellate authority is accepted by the assessee. Assessee has not accepted the assessment order or the appellate order for 1920. Excess money will be 0. Fine. Now, time limit for repatriation 90 days from the date of order. From the date of order. Okay. So, what is the date of order? Date of order is going to be 21st of September, right? So, September will be 9 days. October will be 31 days. November will be 31 days. 62 and then this is 71 and then December will be 20 days. Sorry, November is 30 days. November is 30 days and then December is 20 days. So this will make for the 90 days. So time limit for repatriation by 20th December 2021 for AY 1819 and not applicable for AY 1920. Okay, so this is how we'll have to write the answer. When you write for each answer, do answer for 1920 also. And when you write nil not applicable, you will also have to mention that since assessment stroke appellate order not accepted by the assessee. See, it is not about whether examiner will understand this or not. It is about your understanding of the subject which is made clear to the examiner. Fine. So this is how you have to present for the time limit as well. Now, what else is being asked? Yeah, we've answered this, and rate of interest. Rate of interest will be what? Transaction denominated in rupees. Therefore, SBI lending rate plus 3.25%, which is how much? 9.75% plus 3.25%, which is 13%. Fine. Now, what else have they asked? Interest income if no repatriation, and then interest income plus exit option. So now, same 10 crores into 13%. So I am writing it like this because I have already displayed as to how you should write. You cannot simply write 10 crores into 13%. You will have to write interest income equals excess money into rate into period. So how much is that? 10 crores into 13%. And what is the period? See, up to 20th of December is going to be how much? Up to 20th of December is 90 days. Therefore, another 11 days and 31 Jan, February 28 and then 31, it will be 90 plus another 10. So 191 days. 191 divided by 365. Correct? So how much does that work out to? Let me compute. So that is 68 lakhs 02,740. So 68,02,740 is the interest income if there is no repatriation up to 31st of March 2022. Last stage, I go for the exit option. So 10 crores into 20.9664%, which is the same as last subdivision or last problem, 2 crores 9,66,400, and for interest it will be 10 crores into 13% into, out of 191 we will just be removing the last 17 days because on 15th we have taken it up, correct? So it will be 191 minus 17 will be 174 days by 365. How much does it work out to? 61 lakhs 97,260. So this will be the interest. So we have addressed the second question as well. This subdivision will be your homework. Okay. So with this, we are concluding on the topic called as secondary adjustment. So let's quickly revise what we have seen so far on secondary adjustment. What is primary adjustment? The difference between arm's length price and transaction price is called as primary adjustment. If this primary adjustment is incorporated in the books of accounts, it is called as secondary adjustment. This secondary adjustment has to be recovered from your counterparty, that is your associated enterprise, within 90 days. One small point that I want you guys to know. AIPL has made a transaction with AJC. Should only AJC repatriate or can ASPL also repatriate? ASPL can also repatriate. So repatriation only is mandatory. Which associated enterprise repatriates it? There is no restriction. Even a different associated enterprise can repatriate. Okay. So that is an important point you must know. So the time limit for repatriation has to be made. Now, there are two cases where secondary adjustments will not be applicable. Primary adjustment value is up to rupees 1 crore. No secondary adjustment will be applicable. And where primary adjustment corresponds to assessment year 16, 17 and earlier, no secondary adjustment will be applicable. 5 cases which will result in secondary adjustment. 1 which is suo motu, 2 which is assessment order, 3 which is MAP, 4 which is advance pricing agreement, 5th is safe harbor rules. What is the time span that is generally allowed? 90 days. And what is the amount that has to be recovered? Excess money. What is excess money? Arm's length price minus transaction price. Now, where it is suo motu or safe harbor rules, time limit available is 90 days from the due date of filing return of income. When it comes to MAP, it is 90 days from the date of resolution for the purpose of MAP. Now, when it comes to assessment order or appellate order, it is 90 days from the date of assessment order or appellate order accepted by the assessee. And then when it comes to advance pricing agreements, where the advance pricing agreement is entered before the due date of filing return of income, 90 days from the date of filing return of income and 90 days from the end of the month in which the APA has been entered into, where the return of income has been filed after the date of filing return, sorry, where the APA has been entered into after the date of filing return of income. Now, for the purpose of period of interest, what have we seen? For suo motu as well as safe harbor rules, it is from the due date of filing return of income till the end of the year or till the date of repatriation, whichever is earlier. And for the purpose of assessment order or appellate order, it is from the date of order you will have to compute interest. For MAP, from the date of resolution, you will have to consider the interest. And for the purpose of advance pricing agreements entered into before the due date of filing return of income, interest shall be computed from the due date of filing return of income till the end of the year or till the date of repatriation, whichever is earlier. Where APA is entered into after the due date of filing return of income, it shall be from the end of the month in which the end of the month from which the APA has been entered into till the end of the year or till the date of repatriation, whichever is earlier. Then what is the rate of interest that needs to be considered? The rate of interest that needs to be considered where the transaction is denominated in Indian currency or Indian rupee, it shall be 1 year marginal cost of lending rate of SBI as on 1st April, that is on the first day of the previous year, plus 3.25%. Where the transaction is denominated in foreign currency, it is going to be as 6 months LIBOR as of 30th of September, and it shall be also added up with a 3% on top of the 6 months LIBOR. And then wherever the transaction is denominated in foreign currency, the conversion shall be made with respect to the foreign currency exchange rate TT buying rate as on the last date of the previous year, and then you have to consider the INR value. Then there is an exit option available where you will have to pay tax at the rate of 20.9664%, and that shall end the story of secondary adjustment. No interest shall be computed from the date of payment and no more secondary adjustment shall be applicable from the date of payment. And whatever is going to be the tax that is paid shall not be available as a credit, and you will also not have the eligibility of what is called as any deduction for the secondary adjustment that is being made. With this, we have completed section 92 CE and rule 10 CB. Okay, hope this is clear. So we'll stop it at this juncture and we'll catch up in the next lecture. In the next lecture, we'll be concluding on transfer pricing. So what is the next lecture going to have? The next lecture will be having your 92DA, which talks about specified domestic transaction, and then 92D read with 286, which talks about your country by country reporting and master file documentation. Okay, thank you guys. We'll catch up in the next session.